Your first month in business should be exciting, but these accounting mistakes can turn it into a financial nightmare. Starting business is exciting. You get your first clients, your first payments, and everything feels new. But the first month is also when many business owners make accounting mistakes. Even one small mistake can create confusion about money, expenses, or profit. In this video, we will look at 5 common accounting mistakes that small business owners often make in their first month and how you can avoid them. The first month of accounting is very important because it creates a financial foundation of your business. If your records are clear from the beginning, it becomes easier to understand your cash flow and track expenses. Good records also help you make better decisions about spending and pricing. But if accounting is messy in the first month, the confusion often continues in future months. Many new business owners confuse revenue and income. Revenue means all the money the business receives from sales or services. Income, however, is the money that remains after you subtract expenses. When people mix these numbers, they may think their business is more profitable than it actually is. To avoid this problem, always record revenue and income separately in your accounting records. Small expenses are easy to ignore, but they can grow quickly over time. Many businesses pay for software subscriptions, delivery fees, online tools, or office supplies. Each cost may seem small, but together they can reduce your profit significantly. That is why it is important to record every expense, even if the amount looks minor. Businesses that sell products must manage inventory carefully. Some new business owners forget to record their opening stock or they ignore damaged items in product returns. When inventory numbers are incorrect, profit calculations also become incorrect. A simple habit like tracking stock regularly and checking it weekly can prevent these problems. Another common mistakes Another common mistake is recording transactions inconsistently. Some people update their accounts only when they remember or they enter data randomly into spreadsheets. This creates missing information and makes it difficult to match records later. The best practice is to record transactions daily or at least consistently throughout the week. Memory is not a reliable accounting system. Even organized people forget small payments or recurring subscriptions. When expenses or income are based on memory instead of records, financial reports become inaccurate. Using a spreadsheet template or a simple expense tracker helps ensure that every transaction is recorded correctly. Here is a simple real world example. A small startup forgot to record a $200 monthly software subscription. Because of the expense was missing from the records, their cash flow looked better than it actually was. This caused confusion in budgeting and planning. If the expense had been recorded properly, the problem would have been avoided. To summarize these, there are 5 simple habits that can improve your accounting from the first month. Separate revenue and income clearly. Record every expense, even the small ones. Track your inventory properly. Keep records consistent and use templates or simple tools instead of relying on memory. When these habits start in month 1, managing business finances becomes much easier in the future. Thank you very much.